Welcome back to the last video for Chapter 6. We'll be covering LIFO. That is last in, first out inventory costing method. Now, this assumes that the most recently purchased goods were the first ones to be sold. Thus, last in, the most recent, are going to be allocated to the cost of goods sold, so they are the first out. The earliest purchases will be what's left in your ending inventory in any period. And just in case this isn't already obvious to you, this probably does not in any way represent the physical flow of goods unless a company loves to stockpile their goods. However, it does have some interesting tax and income benefits, especially if the cost of inventory is rising over time. And so some companies do like this method. We'll discuss that at the end of the video. All right, let's go right into an example of LIFO. We're back to our favorite company, Tampico Beachwear, and their Crocs shoes, their inventory of Crocs shoes. It's the exact same series of transactions, but now we're going to see how the accounting of them changes when we use the LIFO example. So first, we said the first step in FIFO or LIFO is to figure out the cost of goods available for sale immediately prior to the first sale. The first sale is on October 8th. So what's the cost of goods available for sale? Well, if we follow our normal method, we'll discover that it's exactly the same amount as it was when we did the FIFO example, because so far, until there's a sale, there's no difference between LIFO and FIFO. They only start getting different in the way we account for cost of goods sold. So since nothing has been sold yet, they still started with 300 units at $1,600 and on October 3rd added 600 units at $18 a piece. So they still are both starting as of the moment before the October 8th sale. Both methods give us $15,600 in the cost of goods available for sale. So we'll just put that right here. Now it's immediately going to start getting different when we have our first sale. On October 1st, they are going to sell 800 units. Now this is last in, first out. What was the last group of inventory in? Well, it was the purple units, the 600 purple units at $18 a unit. So it's an 800 unit sale, so we're going to sell all 600 of the purple units at $18 a unit. So there's $10,800 in cost of goods sold right there. And then they still need 800 minus 600. They still need 200 more units to complete the sale. So those 200 units, they'll go back to the next one. Remember, we're going to work backwards this way. In LIFO, we're moving backwards. So I already used up the 600 units, and I'm going to use 200 of the $16 units. So that's going to be $3,200. So my total cost of goods sold for this first sale is going to be the $10,800 plus $3,200, which is going to get me $14,000. Now, so what's left? Well, we used up all of the $1,800 units, so there's no ending inventory of those. And we had 300 units of the blue at $16 a unit, but we just sold 100 of them. Excuse me, we sold 200 of them, so there's 100 left. And there's $16 a unit. So right now there is $1,600 worth of inventory available for sale as of October 8th. Now we don't sell anything on October 15th. We actually buy some more inventory. So we're going to add another $5,000 worth of inventory to the bucket. So we're going to have $6,600. And then on October 20th, we're going to add another $3,300 to our inventory closet. And so now I have $9,900 worth of ending inventory. So when I get to October 25th, and when I have my second sale, I'm starting, my cost of goods available for sale is $9,900. Now how do we deal with the second sale? Well, it's last in, first out. What was the most recent grouping of inventory to come into our inventory closet? Yep, it was the green purchase. So I've got 100, I'm going to sell all of those because it's a 300 unit sale. So I can sell 150 units of those. at $22 a unit. So that's $3,300. Does that complete my sale? No, it does not. I still need 150 units to sell, right? Where am I going to get those 150 units? Well, I've used up the green bucket, but guess what? I have the 250 red units. I only need 150 of those. They are $20 a unit. And so I am going to be using $3,000 worth of them. So my total cost of goods sold now for this sale is $3,300 plus $3,000, mean it's total COGS of $6,300. Now, what's left? Well, did I use up all of the units from the blue inventory grouping? No, I did not. I still have that 100 left, right? Did I use up all the purples? Yep, I already crossed it out. We already used all those up. Did I use up all my red ones? No, I actually only sold 150 of those just now, so I still have 100 units of those left. So 100 units at $20 a unit gives me $2,000, plus I still had that $1,600. So right now I'll end with $3,600 in inventory. Let's look at that a little cleaner. Notice that first sale. I go right to the most recent. I use it all up, and then I grab some from the earlier purchases. When I get to my second sale, I go straight to the most recent, and then I go to the one before that. Notice, these guys, I am still, at the end of the month, I still have 100 units left of what I started with. 100 units of my original beginning inventory. Now, the total ending inventory is exactly the same as whatever I had in ending inventory after the final transaction. Total COGS was the sum of all of the COGS in the month. Now, we only had 2 sales, and so we have the totals from the 2 sales, and they come up to $20,300. Do you remember what the total COGS was in our FIFO example? Well, it turns out in our FIFO example, the total COGS was actually $19,300, which means that the FIFO transaction gives us a lower amount of COGS. Now, if you think about this, if I have a lower expense amount, that means I would end up with, if it was the same sales amount, which it would be, lower expenses means higher income, higher profit at the bottom of my income statement. Well, that seems like that'd be a good thing, right? Except that the higher my income is, the more I have to pay on income taxes. And companies who don't want to pay a lot on income taxes might want their expenses to be a little higher so that their taxable income was a little lower. So let's compare FIFO and LIFO. When the per unit cost of your goods that you use in inventory, when those costs are rising, FIFO, using the FIFO method, will give you a higher cost of ending inventory, lower cost of goods sold, higher income taxes, and higher net income. Whereas LIFO will give you lower value to your ending inventory, a higher COGS, meaning higher expenses, thus lower income taxes and lower net income. That means if your goal is lower income taxes, you like LIFO. If your goal is to show your shareholders, and maybe your mom, a higher net income, then you're going to use FIFO. Now, companies have competing goals. There's lots of different reasons why they might choose different inventory methods. But just so you can understand that there are definitely differences to what we get in these 2 methods. Now, it's exactly the opposite when the cost of inventory is falling. FIFO gives us a lower ending inventory dollar amount, a higher COGS expense, lower income taxes and lower net income. LIFO does the opposite, meaning it gives us more value in our ending inventory because remember, in LIFO, we use the most recent inventory groupings. If inventory costs are falling, the most recent ones are the cheaper ones, and what we're ending in our ending inventory with were the most expensive ones from the beginning of the period, because costs were falling, meaning at the beginning of the period the inventory was more expensive. Thus, cost of goods sold expense will be lower, and you'll have higher income taxes and higher net income. This concludes Chapter 6.